25 basis point rate cut is the official news. So we have a rate cut, and this is something that the market had baked in. So we have the official news now.
And the reaction is down, Anuj. Was the market going in with maybe 50 basis points? The Nifty bank, the Nifty itself, the Sensex. The first tick is on the downside. The benchmark bond at 6.443.
I guess let's do one thing. Let's go close to Lata, because the first reaction is slightly on the negative side, but then things can improve from here. Lata.
Well, it's a 25 basis cut, and there's just that. There's nothing more that I can add. It's a deeply divided house. 3 people have voted for 25 basis, which is the governor himself, the Deputy Governor Viralacharya, Chetan Gate and Pami Dua. 4 are in favor of 25 basis. Ravindra Dholakia wanted a 50 basis cut, and Dr. Patra wanted a status quo. It's difficult to guess whether the stance of the MPC is any softer. I'll just read the paragraph in question. The MPC noted that some of the upside risks to inflation have either reduced or not materialized. The baseline path of headline inflation, excluding HRA, impact has fallen below the projection made in June to a little over 4% by Q4. Inflation excluding food and fuel has fallen, and rollout of GST has been smooth. So, well, basically, I'm not able to tell you whether the MPC is in a mood to cut further. That is not very clear
Lata,
from the policy.
Let's do one thing. I'll come back to you. Deepak Parekh joins us, Chairman of HDFC. Mr. Parekh, good afternoon. Your first thoughts on the rate cut decision that we have from the RBI. It's 25 basis points.
I think it's not a surprise. It was expected. All of you expected it. The entire financial business community expected it. And inflation numbers have come down. The food prices, barring 1 or 2 items, are lower. And even tomatoes and onions are very short term. It is hoarding, it is APMC and all, which brings the prices up. It's a cartel that is pushing the prices. Actually, prices will come down. And I agree with the stance Reserve Bank has taken, that the GST implementation was not as bad as we all expected. It was fairly smooth compared to what was expected. So I think it's a good boost to the economy, and I think it was expected, and the MPC have taken the right decision. The wisdom of the MPC.
Parekh, I just want you to I just want to tell you about the forward-looking statement. I think the MPC remains very neutral and does not give away whether there will be another cut. And this is the paragraph, operational paragraph. The MPC observed that while inflation has fallen to a historic low, a conclusive segregation of transitory and structural factors driving disinflation is still elusive. In respect of inflation-sensitive vegetable prices, some prices are recording spikes. Excess supply conditions continue to push down prices of pulses and keep those of cereals in check. The MPC will continue monitoring movements in inflation to ascertain if recent soft readings are transient or if a more durable disinflation is underway. So it appears that they have not closed the door for another cut, but they seem to remain data dependent. And I think that should largely be seen as neutral to mildly positive, you would say. I mean, how would you read this sentence? One more cut is possible?
I would say that, we are not in India, we are never comfortable giving forward statements. And Reserve Bank rightly, the MPC committee rightly have worded it in such a way that it sounds totally neutral. At the same time, they are not willing to give hopes to the market that, in 3 months, 4 months, there'll be another rate cut. So they have to be fairly neutral, and I think they've done well by saying that. And we don't like giving forward statements.
Yeah. No, I would assume that in a way the MPC does not want to remove risk from the system by sounding too dovish. People will start pricing in perhaps lower yields. So maybe that's also. But the point is they've not mentioned anything about exuberance in bond markets or CP yields falling very low. It's just remained on inflation and nothing else. Anuj, are the markets responding positively at all?
No, right now the reaction is on the negative side, Lata. In fact, 35 points down on the Nifty and about 50 points down on the Bank Nifty. So the first move is actually on the downside. And, Lata, this could be interesting because, maybe this is, the market's reaction would be, is there a rate cut which is left in the system? Or with this rate cut out of the bag, is that as a positive trigger now out of the window? I think that could explain maybe the near-term disappointment that we're seeing.
Anuj, there is a bit of a positive. There is a bit of a positive for banks as far as LCR guidelines are concerned. That is the liquidity coverage ratio. Now some of their reserves will also be recognized as the liquidity coverage ratio. So they may not have to buy too much bonds. This is bond negative because banks will not have to shore up or store too much of bonds. So that could be a little bond negative, but positive for banks in the sense they can lend more and keep less in government securities. But that's minor. That will ensure that the bond market doesn't react too enthusiastically. Well, otherwise, there is a lot of information on setting up committees to improve credit information availability. I think this is the operative statement. There is also a move towards tripartite repos. Introduction of tri-party repos will likely contribute to better liquidity. So there are draft directions that will come in. A simplified hedging facility is also going to be made available. That's about the operational statements. Back to you.
But
Okay.
Lata, I just want to point out here, while the equity reaction is very measured, the bond market reactions are actually very, very flat. It's actually the currency that continues to run away. The rupee is now breaking to a level of 63.71. It's actually appreciated even more after the policy. There's a 0.5% move underway and some tremendous strength that we've seen. I mean, I don't know if there was something in the fine print that has any bearing on Forex, Lata.
At the moment, nothing on Forex at all. You know, we got this paper about 4 minutes before 2:30, and it's a good, 10 pages to read. But I can't find anything for Forex. You know, the rupee was strong even before the policy. And, you know, if the RBI is hawkish, then there will be flows into debt. If the RBI is dovish, there will be flows into equity. Either way, the rupee is headed higher. There is nothing in the policy at the moment that you can say is rupee positive or negative.
Sure. Okay, Lata, of course, we'll have the RBI governor addressing the press soon. But Ashwani, just before we move to our fundamental experts, I just wanted your thoughts on whether you would trade this move on the Nifty or the Bank Nifty.
See, my view is with the initial move, there are probably shorts which have gotten trapped into the system. The reaction is not negative, and these shorts can take the Bank Nifty higher because we are dealing with a narrow range day, and just a little bit of positive news or positive statement can easily make the Bank Nifty rally 80 to 100 points. So the negativity of the first 2 minutes has totally been wiped out, and I would think that from here you should be taking long positions on Nifty as well as Bank Nifty.
Okay. Well, Anand, your first thoughts. 25 basis points, pretty much on expected lines.
Pretty much on expected lines. I guess the policy, whatever Lata read out, seems to indicate neutrality and a cautious, let's look at the data and then move forward kind of approach. 141 also indicates a neutral kind of approach overall. I guess we'll be very interested to see what comes out in the press conference, what directions the RBI gives, particularly in relation to things like the foreign exchange situation. While we discuss monetary policy in light of CPI and policy rates, there is an impact of that clearly on the external sector. And the fact is, interest rate differentials do favor the rupee at this point in time. So is there any indication that the RBI is taking cognizance of this? There are growing unhedged exposures in the system. Likewise, is there any glide path towards liquidity? With the increased MSS limits, the RBI might be contemplating soaking out the liquidity. Is there some glide path on that? And overall indications on whether they think that there could be room for more rate cuts going forward. So I think listening to the statements from the RBI will be the next port of call. Otherwise, pretty much along expected lines. I don't expect a big rally in bond markets. If anything, bond markets will probably be cautious, seeing this as more neutral despite the extremely low CPI prints that we've seen.
Okay, by the way, the market is actually making a move now on the upside. State Bank of India, let's just pull out the intraday chart of State Bank of India. That stock up about 0.5% right now, and most of that has come post policy. So interesting, Surabhi, maybe some shorts getting covered, but interesting move as far as the Bank Nifty is concerned right now.
Yeah, that's what seems to be taking place right now. Some of those stocks like SBI are really spiking. I was just looking at any kind of forward-looking statements on liquidity management. Can't seem to find it in the release, at least right now. There's just, of course, a note of the excess liquidity that has been around in the system, with the release saying surplus liquidity conditions persisted in the system, exacerbated by front-loading of budgetary spending by the government. reflecting this active liquidity management, the weighted average call rate firmed up and traded about 17 basis points. But this is all actually backward looking. Yet to sort of get a hint of how the RBI is thinking of managing liquidity in the future. For that, we'll have to maybe wait for the press conference. But Sajid, the first thoughts looking at some commentary that we've got from the release and the cut itself.
No surprises, really. I think exactly what people expected, that, as I mentioned earlier, the focus is largely exclusively on inflation, as it should be. I mean, let's not burden this new monetary policy framework with other objectives. The objective here is singularly, where is the inflation outlook and how close to 4% will it be? I think from what Lata read out, what the MPC seems to suggest is first quarter of the next calendar year, which is last quarter of the fiscal, excluding HRA, inflation was slightly above 4%. So I think in a range which could go either way. And I think rightly so, the MPC is going to be data dependent. Nobody really knows how much of the disinflation is cyclical versus structural. We just need a little more data. I'll make one other quick point. I think we should learn to separate liquidity management from the rate structure, just like the Fed is doing in the US, where they don't want the balance sheet normalization to be an indication of their monetary policy stance. I think the same thing in India, that we may well have a situation where the RBI is cutting rates but draining liquidity. Because remember, the operating framework of this, the operating target of this new framework is to keep the weighted average call rate at the policy rate, and that has not been the case because of the excess liquidity in the system. So you could well have a situation where liquidity is drained to meet your operating target limit targets. At the same time, disinflation in the future could open up a little more space potentially for rate cuts. So both things could be simultaneously true.
Okay, Dilip, your thoughts on the market action? It's been very volatile today, even on the Nifty, the bank Nifty. The market got what it wanted. I mean, maybe you could argue that it was not 50 basis points that some had started to factor in. But do you think this disappointment would be just near term?
Well, I think I would interpret more like it's a neutral one for the market. Nothing really negative about it. At the same time, markets will continue to look for some of the positive things overall as and when the press conference starts. And possibly, markets will forget this event by tomorrow. And I think we'll be back to those fundamentals, the results, and how does the next couple of quarters work out, especially the third and fourth quarter in terms of the run rate for the corporate earnings and also for the kind of economic growth rate that can come in.
Sajid, I want to come back to the point on inflation, because now I'm reading through the commentary and it's interesting because the central bank is obviously taking note of several factors that can influence its current baseline projection. So they're obviously talking about, the implementation of the 7th Pay Commission, the GST final price moderations that we'll actually start seeing as companies, figure out what they want to charge on MRP. And then there is a very clear mention to what states are going to do with respect to the sort of salary structures that they have in place and the loan waivers. I'll just read out one or two lines where the RBI says that there are several factors contributing to uncertainty around this baseline inflation trajectory. Implementation of farm loan waivers by states may result in fiscal slippages and undermine the quality of public spending. I'll shoot down a couple of lines and say if states choose to implement salary and allowance increases similar to the center, then the headline inflation could rise by an additional estimated 100 basis points above the baseline over the next 18 to 24 months. Also, high-frequency indicators suggest that price pressures are building up in vegetables and animal proteins. Is this bordering on slightly concerning? I'm not going to use the word hawkish, because let's wait for the governor to speak himself. How do you interpret this part of the commentary?
I think these are just, I would call this cautious, and I would say rightfully so. I think they're basically restating facts here. I think you're seeing some high-frequency food prices pick up. The question is, will it sustain or will it mean revert in the coming months? And all of us have been acutely aware about the fact that there's a central HRA which adds about 40 basis points. The state HRAs, if done all together over the next year, will add another 100 basis points. And there is uncertainty about the GST, though, the early indications are that this will really not be very inflationary. But I think the RBI is simply restating the risks that it has been pointing to since the start of the year. One can argue at the margin some of these risks have faded, but they still very much exist. So I would not overinterpret those factors. I think my sense is the MPC is going to be very data dependent, and the data in the next 3 or 4 months will tell us how those risks get realized or not.
Okay, by the way, right now it's really curious the way the market is reacting, because now you have the major indices actually slipping into the red. We have the mid cap index down about just turning flat, but the Nifty is almost at the low point right now. It's very volatile all over the place. Let's just pull out the tick by tick data and see what's happening on that one. Lupin, for example, has moved to low point of the day. This is of course apart from policy. So just keeping an eye on the market as well. Maruti has moved to the low point of the day. So, Ashwini, from a market point of view, how do you approach some of these rate sensitives now? The likes of banks, autos, real estate.
Well, we were in a narrow range, and that narrow range has not been broken. So from tomorrow onwards, it's regular market. I don't think much has changed today. So just keep buying them on dips. I think they should continue to outperform.
Mr. Khara, now that we've seen the policy announcement and this 25 basis points rate cut has come in, what does it mean for overall rates in the system? So on the savings side, obviously it's going to pinch people like, me and Anuj and others like us. What about lending rates? Do we see a downward movement from here?
I think we had already adjusted the rates as far as the loans were concerned. Our MCLR was already tweaked for this.
Okay, let's just cut across to the governor.
Okay. Good afternoon, everyone. The Monetary Policy Committee took note of an important change in the baseline inflation trajectory with respect to the June 2017 statement. This trajectory now incorporates the first round impact of the implementation of the house rent allowance award of the 7th CPC by the central government. Excluding the HRA impact, which will affect the CPI cumulatively, headline inflation would be a little above 4% by Q4, as against 4.5% inclusive of the HRA in the June statement. Another important development noted by the MPC is that inflation excluding food and fuel, which has hitherto been sticky, has fallen significantly over the past 3 months. These factors, along with the normal and well-distributed rainfall and the smooth rollout of the GST, opened up some space for monetary policy accommodation. Accordingly, the MPC decided by a vote of 4-2 to reduce the policy rate by 25 basis points. Recognizing, however, that inflation is expected to rise from the current lows over the rest of the year, the committee persevered with a neutral stance. With several factors contributing to uncertainty around the baseline inflation path, implementation of farm loan waivers, the after effects of the GST, the timing of implementation of salary and allowance revisions by the state governments, the MPC emphasized its commitment to keeping headline inflation close to 4% on a durable basis. While retaining the projection of real GVA growth for 2017-18 of 7.3%, same as the June 2017 forecast, the MPC noted that while the outlook for agriculture appears robust, underlying growth impulses in industry and services may be weakening slightly. Given corporate deleveraging and the retrenchment of investment demand. In this context, it was of the view that there is an urgent need to reinvigorate private investment, remove infrastructure bottlenecks, and provide a major thrust to the affordable housing program of the government. The government and the Reserve Bank are working in close coordination to resolve large stressed corporate borrowers and recapitalize public sector banks within the fiscal deficit target. Eventually, these efforts should help restart credit flows to productive sectors as demand revives. I'll now request Dr. Acharya to say a few words, and then Mr. Vishwanathan.
Thank you, Governor. Good afternoon, everyone. As we mentioned in the past, and as Governor has just underscored, addressing the twin balance sheet problem remains the Reserve Bank's top priority at the moment. investment slowdown in our assessment is significantly rooted in the resulting debt overhang problem from this twin balance sheet issues. With the cleanup on banks' NPAs currently underway, we are striving to meet in near future an important prerequisite for effective transmission of monetary policy, namely robust health of balance sheets in the financial and the real sectors. In order to supplement these efforts, let me mention 3 developmental steps that the RBI will be undertaking to improve financial intermediation in the economy going forward. One, will be releasing in coming weeks the final guidelines for tri-party repo, which we hope will pave the way for a vibrant corporate bond borrowing and lending market, providing better liquidity and price discovery, reducing market cost of capital, and allowing access to non-bank finance for a greater number of borrowers in the economy. A thriving corporate bond market would in itself improve monetary policy transmission by creating a direct impact of interest rate changes on a bigger part of the real sector in the economy. Second, to improve transparency in credit markets and to facilitate better early intervention as well as risk-based counter-cyclical provisioning, the Reserve Bank has decided to put in place a high-level task force comprising experts and relevant stakeholders. This task force will evaluate the existing public and private infrastructure for credit information, assess any data gaps, study the best international practices, and provide a roadmap for the development of a comprehensive near real-time public credit registry for India. Let me stress that the objective is to improve not just the credit assessment by financial lenders, but also of the financial lenders themselves. Third, the experience with the marginal cost of funds-based lending rate or MCLR system introduced in April 16 for improving monetary transmission has not been entirely satisfactory, even though it has been an advance over the earlier base rate system. We have constituted an internal study group across several clusters to study the various aspects of this MCLR system and to explore whether linking of the bank lending rates could be made direct to market-determined benchmarks going forward. The group will submit the report by September 24th, 2017. One last point, the currency in circulation is showing early signs of normalization. There remains, however, much surplus liquidity in the system that the Reserve Bank has been managing. We remain in touch with the government to make our toolkit for this task more complete. In the meantime, we will continue with surplus liquidity management using instruments indicated in the April policy. Thank you.
Mr. Vishwanath.
I'll begin with the point which Dr. Acharya referred to on the credit registry. We have been taking progressively measures to improve the effectiveness of the credit information that is filed with the credit information companies. And this reforms started with requiring all the banks to report all the data to all the RBI, so that there is no fragmentation. Subsequently, we wanted them to dovetail the SSG data into the credit information company system, and now we are making it mandatory for the CICs to issue what is called a comprehensive credit information report, because they used to carry the reports in various subsets in the form of what you call industry, personnel, MFI, and things like that, and they used to only give information based on the particular area from where the demand is coming. Now we think, irrespective of where the information is being sought by, the comprehensive report covering all the bureaus in which the information is kept should be provided to the credit information seekers, so that the quality of credit assessment is better. The second, of course, is again Dr. Acharya referred to the improvements that we're looking at the MCLR and what to do going forward. But when we introduced the MCLR, we are also allowed the banks that were the existing borrowers under the floating rate and the base rate system, they could move to the MCLR on a mutually acceptable terms. But we find that the base rate is relatively more rigid. So we need to look at, because quite a few borrowers are still under the base rate system, so the monetary transmission is to that extent impacted. So we will look at how we need to how we can make the base rate a lot more responsive to changes in the cost of funds of banks, and that's something that we'll be exploring very shortly, and we'll then have a discussion with the banks on this issue going forward. On the NPA front, as we know, we have taken substantial action after the Banking Regulation Amendment Ordinance was passed. As indicated in the press release of June 13, 2017, we have, on the basis of recommendation of the Internal Advisory Committee, and directed banks to refer 12 cases for resolution in the IBC. All these 12 cases were referred by the banks to the IBC, under IBC, and they are in the various stages in the NCLTs of the respective NCLTs, the respective benches. Of course, dealing with this test assess is an ongoing process, and we're working on the next steps in this.
Okay. Thank you very much. Take a few questions now. Hindu Business Line. Use the mic, please. Thank you.
On the one hand, there is a liquidity overhang in the system. Yeah. So, do you think there was a need at all for you to cut the rates, and when you also have a situation where inflation could rise down the line, actually?
Well, you know, we have been facing the challenge of liquidity overhang for some time, and we are managing that. We are keeping the weighted average call rate within the policy corridor. Reducing the width of that corridor is something that was part of that toolkit. And while our statement acknowledges that from the current lows, inflation is likely to rise, it is going to be about 4% by Q4. And given the factors that we have pointed out, that inflation excluding food and fuel has fallen significantly over the past 3 months. Once we exclude the impact of the HRA, which is one source of uncertainty, HRA from the central government side has now been taken care of, and including that in the projection still brings us close to 4%. And we had said that this was a statistical exercise, and therefore it's right for us to net that out. I think what we have done is taken a calibrated policy decision based on the outturns and our projections going forward, and we felt that a 25 basis point cut while keeping the stance neutral was something that we should be doing at this juncture. Mint.
Sir, hi, this is Alik from Mint newspaper. Was a rate cut in October under discussion in the MPC, because by then you would have got 2 more inflation prints, a GDP data, and a clearer picture on surplus liquidity in the banking system. Also, you are now taking measures to improve MCLR transmission. So why not October? Why September? Sorry.
That's a good question. You know, the data flow is, of course, these days continuous, and we did have the GDP numbers that were released a couple of months back. We also had 2 more data points regarding the inflation print itself, and encompassing the development since June, the normal monsoon, the smooth rollout of the GST, the inflation excluding food and fuel coming down. We thought that this was an opportune time to do a 25 basis point cut. Govardhan?
Good afternoon, Govardhan from the Economic Times. You mentioned about several factors contributing to uncertainty around this baseline inflation trajectory. Put this in the context of what Dr. Acharya mentioned in the minutes in the last meeting about a higher interest rate. So that appears to be called for a bigger buffer. So what is the kind of a buffer from now? Is it not 1.25 to 1.7, something bigger? So what is that you would be comfortable with, the positive real rates?
I think we are, so one, I would say we are looking at the real rate as one of the drivers into the decision making. It's not the sole component. And you know, it's best to look at the real rate more when you think things are steady rather than when things are actually have gone through a fair bit of uncertainty as we have over the last year. Nevertheless, I think if you take the 6% rate and you take our projected rate of slightly over 4%, I think we are talking about something maybe slightly in excess of the range that you are talking about. My own view, as I had stressed in the minutes last time, was that this is all right in a time when transmission is actually not necessarily guaranteed to work as well, given the structural issues of debt overhang that have been flagging. So I think we are just slightly outside of the range of 1.75%, and we are comfortable with that.
Hindu?
Now, we have seen recently SBI. We have seen SBI has cut the savings bank rate. So clearly they are indicating that margins are under pressure. So with this rate cut, do you expect really banks to transmit bank to follow you by cutting lending rates further?
You know, the way to look at the transmission is to determine what has been the case since we started the easing cycle. There are 2 or 3 things that are clear. One, that on new lending, the transmission has been much stronger, especially in those segments where there is a lot of competition. So, you know, housing loans and personal loans, where the NBFCs also play a big part. Secondly, on the part of the loan portfolio that is tied up with on account of base rate and liabilities of a longer nature, the transmission has been slower. Given the liquidity conditions prevailing and that we have reduced policy rates by a substantial amount since the easing cycle started, I think there is scope for banks to reduce lending for those segments that so far they have not yet benefited to the full extent of our policy rate cuts. Cogensis.
Thank you, sir. Bijoy from Cogensis here. Sir, this is effectively a 5-1 vote in favor of easing. It's not a 4-2. There is a lack of sync between the RBI members voting itself. From February, when there was a stance change to eventually having to cut your CPI inflation projections, and having a 5-1 vote in favor of a status quo last time. This is the 5-1 vote in favor of an easing. It's a sharp movement in the last 6 months. Do you think it shows that, you know, there is certain amount of dissonance and there are too many factors that are moving, which means that different people have different views even within the RBI?
Well, you know, firstly, there is a reason why we put out the minutes, so that the individual members can give their specific reasons for their vote decision, and possibly to explain why they changed their minds from June. I think the resolution itself, on balance, very comfortably shows why we went for a 25 basis point cut compared to the status quo in June. We have had more data points, some uncertainty has been resolved, and the substantial reduction in inflation excluding food and fuel. So I think it's all explained. Bloomberg Quint.
Hi, sir. Ira from Bloomberg Quint. Question on, in para 19, you talk about the fact that upside risk to inflation have either reduced or not materialized. And then you say you expect to maintain that projection of 4% by the end of Q4. Why did you not change your stance while cutting rates? And also, if you stay on this path towards 4%, should one assume that this is the extent of accommodation you think was possible? Only if we start to see further deceleration in inflation or quicker disinflation could we see further room open up for rate cuts?
Well, you know, let me refer to paragraph 19, where we make it clear why we are sticking to the neutral stance. That given that the trajectory of inflation is expected to rise from the current lows, that is the main reason why we have been cautious enough to stick to the neutral stance, and therefore, you know, there is nothing to explain in terms of why we have not changed the stance. The stance is exactly where it should be and what it was in June, and therefore I think it was the right call to make by a majority of 4-2. CNBC आवाज.
सर, जैसे कि डॉक्टर आचार्य ने कहा कि जो ट्रांसमिशन है वो एनपीए रेजोल्यूशन पे काफ़ी हद तक डिपेंड करता है. एक दौर में हमने 12 कंपनियों के सामने कार्यवाही शुरू होती हुई देखी है. क्या आगे कुछ और सिलेक्शन आप करेंगे, कुछ और नाम आप चुनेंगे उन कंपनियों का जिनसे रिकवरी की कार्यवाही बैंकों को प्रायोरिटी पे करनी चाहिए?
I request Mr. Vishwanathan.
I think I'll reply in English. I think I've stated in my opening statement that dealing with the stressed assets is an ongoing issue, and we are working on the next steps. And I think that answers your question. We're working on the next steps.
That's one question at a time, please. Lata?
Sir, on liquidity, I mean, by when we have been, although we have a neutral policy, we have had a fairly accommodative liquidity. By when do you think that will be drained, if you can give a timetable? And because of this liquidity, do you worry that yields in some places have really fallen? Don't you worry about the credit quality of some NBFCs, some mutual funds, some CP yields have fallen to 6%? Is there a worry at all?
Yeah, I think this is a good question. We are certainly examining this very closely. I would make 3 points. One, we were clearly remonetizing, and we had to wait and assess when we think the system is actually reaching a stable level of currency in circulation. Like one way I think something is stable when it bounces around its level. And I think it's only recently that this has started happening. Otherwise, we've just been remonetizing at an increasing pace, and currency in circulation has been going up. So one, we had to give ourselves a certain amount of time to know whether the system is actually getting the currency that it requires. Two, having said that, as you know, we have been mopping up a lot of liquidity on 7, 14-day and 28-day variable rate reverse repos. We've also started conducting open market operations at a fairly, I would say, gradual pace of reasonable amounts. Our intent is not to actually destabilize or shock the markets in any way. Third, we will continue watching the currency in circulation numbers closely to get a sense of whether we are at now the right level. And if yes, that will give us a sense of assuming reasonable growth numbers where we might currency demand to be in, say, 6 months, 9 months, or 12 months' time, and that will lead to our calibration of the liquidity, of the more durable liquidity operations like open market operations that we might have to do.
So credit quality.
I think the one question at a time. And BBC?
Thanks a lot, Governor. So you have mentioned over here in the 20th paragraph that the government needs to take steps to look at private investment, remove infrastructure bottlenecks, and if you even look at the recent data that's come out, whether it's industrial production, factory output, that has weakened. How big a concern is that, and how much does that really play a role in influencing this decision to go for a rate cut?
I think we have mentioned that we could have a stronger growth performance if some of these things are taken forward. In particular, removing infrastructure bottlenecks, finding measures to reinvigorate private investment, and provide a thrust to the affordable housing initiative of the government, which has the potential for very strong multiplier effects. And I think a fair number of pieces of the jigsaw in that context are already in place. There is one that we have, we are aware of, and which, according to several stakeholders, is coming in the way for speedier implementation, is the clearance of these projects on affordable housing at the state government level. I think we need a time-bound, single-window clearance if this very important initiative, which has the potential for very strong growth impulses going forward, to come into place. So, okay, that's it. Thank you.
Okay, so that is the policy and the commentary that has come through. The governor there also explaining what moved the needle this time around for this 25 basis point cut, yet perhaps still sounding somewhat cautious on the future trajectory of inflation. Anuj, and I guess maybe that's why slightly more measured response from the market. Though, of course, right now we've recovered from the initial lows that we hit after the policy announcement.
Yeah, I think the market is fine, Surabhi. Look, the initial disappointment could have been that is the last rate cut out of the way, because the initial reaction was that maybe it's a bit of a hawkish cut. But now I think there's some room for maybe one more rate cut left. Also, in some corner there was expectation of 50 basis point rate cut. So obviously that didn't happen. So I think that explains the big decline that you saw in PSU banks. But I think the market's already moved on from the policy, Surabhi. Look at what's happening with a lot of individual names. I think tire stocks, for example, Apollo Tyres has moved to the high point of the day. CEAT has moved to high point of the day. Balrampur Chini is back to the high point of the day. So a lot of these individual stocks are already moving. So the policy, as we normally found out, is half an hour affair, and after that the market moves on.
Okay, so that's what's happening right now. Quite a few bank stocks actually also rebounding. HDFC Bank, IndusInd Bank, a lot of these names now climbing to the higher side of the screen. Well, we've got our guests with us, so let's just get some thoughts in. Mr. Khara of SBI with us as of now. Mr. Khara, I mean, the one statement that of course caught everybody's eye was the governor saying that he still thinks that transmission is not complete. He still thinks that there are pockets where lending rates should come down. Your thoughts? Okay, I don't think we have that line through with Mr. Khara. We'll just go back to all our experts in just a moment. But going back to some of the market's moves right now, the one stock that you'll have to say has been really amazing in terms of reaction is actually Imami. You remember the numbers coming out talking about the disappointment. Now that stock's up about 3.5%. So interesting. Mid caps are really marching forward. Okay, Ashwini, the event is out of the way. The reaction as of now is about a 20 points blip on the screen. I remember you saying you went in long into this policy. What now?
Well, stay long. The policy is out of the way, and all this about hawkish for a monetary policy committee which has changed its stance once. You don't expect them to go to the other side. They are keeping some ammunition with them in case they have to change their stance again. But I think the market is moving on. It is moving towards the high point of the day, and I think from tomorrow onwards, life as usual. A lot of banking stocks fell, particularly the private banks. Those are the places where people can try to take long positions, because post tomorrow, I think the uptrend on the financial should continue. This monetary policy hasn't broken the back of the market. That is the positive, because given the tight range, we could have easily broken that range and gone down much more. This sort of reaction means that a policy out of the way, we should continue with the uptrend.
Okay, by the way, the market clearly is moving on. That's Capital First numbers, and once again, some of these NBFCs have come out with good numbers, and it looks like that's continued with Capital First as well. Ashwini, any thoughts on this stock?
See, Capital First spent a lot of time in this 680-700 zone where it bottomed out. I think it's slowly but surely headed towards 850-900, the erstwhile high. And most of these NBFCs will make further new highs in spite of being overvalued, etc. So this is the only place that seems to be coming out with good results. So you should buy them on all declines.
Okay, the governor has said what he has had to say, and so have the deputy governors. It looks like it's an extremely neutral policy, and they will be data dependent. But let me get that from the experts. Anant Narayan, you go first. If you parse the governor's statements and the deputy governors, they want to stick to a little above that 1.75 percentage point buffer between inflation and interest rate. So how did you read it? Was there a space at all for another cut?
I agree with you, Lata. I think this was an extremely neutral policy. Look, we probably have seen the lowest of CPI inflation. Going forward, we expect the prints to start going about 2%. And there is a good chance that by the last quarter of this fiscal, we head towards the 4 and 4% plus kind of mark. So with that trajectory, future rate cuts would be very data dependent. If we get further positive surprises on inflation, i.e. lower inflation, then one more rate cut cannot be ruled out. But as things stand right now, I'm not sure if this RBI or this MPC is very keen on delivering more rate cuts. So it looks very neutral, very data dependent, and as a base case, with inflation heading up, unlikely we'll see too many rate cuts going forward. Overall, though, there are some questions which remain unanswered, both on the rupee side as well as on the fact that we are seeing a lot more savings going into capital markets and equity classes. But those are issues which have not been discussed in the policy.
Okay. Well, a lot of questions are not answered. Even questions we asked were not answered. So no question of expecting rupee kind of questions to be answered. I'm coming back to you on the liquidity and other issues that were raised. But Mr. Khara, what did you make? There is a rate cut to abet what you have already done. Is there a chance that now term deposits also will go down further and a lending rate cut is around the corner?
Well, of course, lending rate cut as of now is a function of MCLR, and MCLR is a function of various components. So we'll have to revisit all the components and we'll have to review the position. And if at all there will be a scope, we will probably look into it. But the mood factor is that, of course, there is a huge liquidity which is there in the system as of now. And we are looking for an opportunity to lend for the right kind of bankable projects. So I hope with this, if at all, it improves the sentiments of the corporate sector, and they come forward for their investment projects. This will probably absorb the liquidity which is there in the system. And we have been seeing good traction as far as the retail loans are concerned. We hope that particular piece will continue going forward. So that's how I look at it as far as the policy rates and its impact on the lending activity is concerned.
Mr. Khara, that's an extremely academic answer. I'm just asking you to read the tea leaves. If not for your bank, do you see lending rates falling because deposit rates also could tumble, primarily for the same reasons?
I think in
should
general,
we in maybe
in general for in general for the banking system as a whole, I hope it should have an impact. But the point is that there's a whole lot of liquidity already there in the system. Almost about 300,000 crore kind of a liquidity is there, either into OMOs or into MSF. So, and that kind of a liquidity already there to absorb the opportunities which are there. So I think people are looking for the right options, and if at all, it will probably help in sort of absorbing the liquidity. They are quite open. System is quite open for that, and I hope the banking system will probably respond like that.
Well, we'll come back to you, sir. I think you're being extremely cagey about whether you see a lending rate cut. After all, that's what the entire market is watching and waiting. And you'll have anyway had a bonanza with your rate cut in the savings bank account as well. But let me get quick thoughts from Abik and Sajid as well. Sajid, your takeaway in terms of any further cuts left?
Lata, I think the policy was very much on expected lines. I think my own sense is the bar for every subsequent cut gets higher. If you look at the language, the RBI's inflation forecast is that excluding HRA, we're still looking at a number slightly above 4% by the first quarter. So I think if that were to pan out, I wouldn't pencil in any more cuts. I think what one needs to see is a meaningful undershoot of the 4% level, and the MPC having some confidence in that to engender another cut. So I think that the bar will get higher. And I'll just make a quick point that I made before. We have to now decouple liquidity management from interest rate policy. You may well have a situation where liquidity is progressively drained because the operating framework calls for the weighted average call rate to be at the repo rate, and the excess liquidity has meant that it has consistently undershot the repo rate. So both things could be true, just like the Fed is doing in the US. You could be draining liquidity here while cutting rates and decoupling both of these things.
So effectively for borrowers, you don't see money getting cheaper?
Well, I think in the wholesale market, at least, this was largely priced in. So I don't see much reaction from here unless inflation in the next few months again begins to substantially undershoot and one more rate cut is priced in. And I think for banks, the fact is monetary conditions have already gotten much easier given the huge quantum of liquidity. And I think we have to accept that there's only so much bang that easier monetary conditions are going to have on credit growth. Despite much easier conditions in the last 2 years, we've seen credit growth only begin to slow further. So at some point, we have to stop focusing on monetary policy and focus on the other drivers of growth in the economy.
Oh, I guess RBI is always highlighting that. I wasn't looking for answers on credit growth as much as price of credit, whether that can get any cheaper. Abik?
Well, I'm going to be very cautious about the outlook on both rates and liquidity going forward. Clearly, I think the MPC is being very cautious. I think it's intrinsically hawkish, and I think given the fact that its projections, excluding certain sort of extraordinary components, is 4% for the last quarter, I would not bet on another rate cut. Coupled with this, you might have, more accelerated liquidity draining measures, as Sajid mentioned, as you have a normalization of currency in circulation because you're coming out of the demonetization phase, the remonetization has progressed, and so on. So there could be an acceleration there, which would push up the sort of the wholesale cost of funds as well. So I think we are possibly looking at tighter monetary conditions as well as slightly higher rates going forward post the immediate impact of short-term rates to this gesture. So I would keep my fingers crossed. I think there are a lot of ifs and buts around. One of them is, of course, how the state loan waivers are financed, what kind of supply of bonds, whether it's STL or whether some alternative bonds like the Kisan Rahat bonds, etc., that have been discussed, come into the market. So I'm quite cautious about the second half, and I don't think there has been, any signal that the RBI is likely to be a little softer on either inflation or interest rates.
Okay, well, one final question to the bond expert, and then I want Ajay Srivastava to tell me how the stock markets will react. Anand, does money get cheaper for someone who is floating a debenture of an NBFC or a commercial paper? Are money markets getting cheaper, rates getting cheaper at all in the, say, next quarter?
Nada, I think a lot of this has already been priced in, as Sajid mentioned earlier, and I agree with him. So incrementally, in the short term, given the actual operating rate will now move towards 6% or slightly below 6%, you could see a small impact, but clearly the shape of the curve will probably steepen. And that, by the way, is not a bad thing. I think given the nature of the market we have currently, where we have a sharply strengthening rupee on the back of increasing unhedged exposures, where we have growth in the short term looking fairly tepid and short-term inflation looking pretty low, there is a case for short-term rates to remain low. At the same time, let's acknowledge that there are significant uncertainties going forward. The global markets remain extremely uncertain. State government finances and the overall fiscal situation is still evolving. And plus, as we've discussed before, there is an increasing amount of term savings going away from banks into capital markets, and some would argue going into capital markets beyond the capacity of capital markets to absorb them. So given all of that, there is a strong argument for long-term rates to remain on the higher side. So I think on balance, it's probably a good outcome. Short-term rates will probably soften a little bit or stay there. Longer-term rates will probably be a little more cautious. I just wish it was a little more steeper than this to address all the various issues that we have. But there are limitations of the current policy framework, I guess.
Okay, thank you very much, gentlemen, for joining me. And now over to you, Ajay Srivastava. It doesn't look like the NBFCs are going to be able to borrow money any cheaper, but as it is cheap enough. What would be your takeaway at the end of this policy? If you have still kept back any cash, where would you deploy it?
See, I think, Lata, first thing is very clear that with this policy is one of the pieces which is plugging into the system, which tells us that something needs to be done to get the economy going. I think that's the real part. And I think if even it's 25 basis point, it is something for the table to take away. Whether we get another 25, which I'm sure we will get another 25, is going to help a lot. The question is, what happens to NBFCs? Can the funds for them get cheaper? And my answer is yes, it will get much cheaper than that, because for the pure simple reason that the sure supply of money coming into the system cannot be absorbed by any investment activity in the economy. So it has to flow through credit markets, it has to flow to bond instruments, it has to flow to commercial papers, and by that route goes to NBFCs. If you look at the bank's balance sheet, they are not able to deploy the money deposits they are getting into, so they need necessarily NBFCs to deploy the money. So by and large, I think in the next 90 days or so, you will see in fact lower rates, interest rate available to the A-rated NBFC. There is is some concern on some NBFCs lending far beyond what they should have or the credit quality, but by and large, AAA rated NBFCs should see a lower interest rate because the fund flow is humongous at this point of time and the banks have no way to deploy it. You look at the nationalized bank balance sheet, their loans and investments now are at par with each other, and that's the first time I've seen the economy in the last 20 years that if you see all the nationalized banks, the loan and the advances and the investment are at par with each other, which means can you imagine what they're doing today to their balance sheet? So sooner or later, part of that investment will flow back to things like NBFC, etc., which are far more safer to lend to than industrial credit. So there is a huge chunk of money through nationalized banks waiting to come to NBFCs, which so far it has been going into investment, and that tells me that they will have an easier time compared to what they had in the last 2 years or so.
Okay. Ajay, good afternoon. So, look, the policy is done and dusted. Let's talk about the overall market. Do you still buy dips in this market and what kind of dip? Because, the run-up has been so strong.
Well, to be honest, this is a time to take a breather. I think we all are taking a breather because this was an explosive run. And let's not talk of last 1 month. Let's look at just from December till now on the banking side, finance side, it's been a 50 to 60% run up in the market. You need to take a breather at this point of time to see where you want to buy your shares. If you need to invest further, financial services still remains, of course, the number one blot. You have the same old guys who've done the best performance, which is your utilities. Look at Maruti, look at Aisha, look at Yes Bank. They're the same old performers. The name here is to have a call on what do you do with the mid cap. And while we've been talking of mid cap who have done 200, 300%, there is a whole family of mid caps which have lost money. If you look at Dr. Lal PathLab, Advanced Enzyme, Fortis Healthcare, you can name dozens of them which have lost 30, 40, 50%. So I think if you want to invest money, be very careful at this time. And I would still say the winners of yesterday are the winners here. The portfolio choices are limited at this point of time. You got to go with the banking sector, financial sector, because the economy, what the numbers are, we all know the growth is down to, perhaps the industrial production is down to less than 1%. So one can't expect a revival on the capex cycle. One can't expect a revival in the industrial inputs. Maybe some revival on the power side. But by and large, this market at this point of time is favoring the larger companies, and there are opportunity buys. There is definitely, if you look at the space for the apparel, there is some opportunity buys. If you look at some space in a very niche industry, there are opportunity buys. But be careful. This is not a market to bottom fish. If stocks have fallen 40, 50%, be careful and find the reason they have fallen. So stay with the winners. Don't bottom fish in this market is all our advice to everybody.
Okay, well, those winners are definitely taking a bit of a break right now. The Nifty Bank slipped below the 25,000 mark for a bit. In fact, it's exactly at that level now. And some profit booking is underway. And that's the reason why the Nifty is also pretty much at the day's low. Profit booking underway on the likes of an ICICI Bank, SBI, Axis is weak. Entire clutch of banks. Yes Bank also slightly sluggish at this point in time. And then there are big stocks like ONGC, ITC, etc., which are also dragging their feet. So, sub and substance, we're about just 2 minutes away from close, Anuj. So how do you, sum up the fact that this event is behind and the market is, some of, that exuberance seems to have taken a bit of a backseat.
Surbhi, once again, go back to the point that I made earlier as well, that, if you're a bull, you actually, may not want a rate cut because, then that news is out of the way. And, this is a market which is, so far fed on bad news and has done well. I don't want to say whether the market there's any similarity to the last rate cut, but normally sometimes the rate cuts and all sort of put a bit of a top for the market near term. Let's not mistake that. So I would want to see what happens tomorrow. That would be the real test of this market, because after a long time you're seeing a dip, and after a long time the market is actually closing at the low point of the day. The Nifty is closing 50 points lower, the Bank Nifty is closing 165 points lower and below the 25,000 mark. I think it's a bit of a cut that we are seeing. Ashwini, how do you trade it tomorrow morning? Do you still look to buy the dips?
See, for the moment, the narrow range that we had both yesterday and today in the last half an hour has been broken. So at least get out of your long positions. Tomorrow, what you want to do is see if you get buying at lower levels. Otherwise, I would think a range breakdown qualifies as somewhat of a correction that would start. So on rallies, maybe towards today's high, short trades can be tried out, because at the end of the market, I think between 10,100 to about 10,150 seems to have given way. But we'll need to see whether there's follow through tomorrow. But it's not a very simple buying decision, because you are sitting on top of a rally with a narrow range which has broken down on an event. So tomorrow we must get above today's high.
Okay, that's an important part. Today's low is after an event, and that too after supposed good news. Let's just quickly recap the market, and then we'll take some more thoughts from Ajay Srivastav. Ending at low point, 56 points lower on the Nifty, 10,058 is what we have. And of course, in terms of stock action, Indiabulls Housing Finance, Dr. Reddy's, Bharti Infratel, Tata Motors, these were some big losers. Eicher Motors as well corrected intraday. Larsen, SBI, TCS, HUL, ITC was some prominent losers in today's trade survey.
Midcaps, I'll just start with some of the earnings reactions that we've got, Anuj. So for instance, some of the numbers that we saw today, Wockhardt down 3%. Greenply down to 2.5%. Godrej Properties was a bit of a miss, 2.5% lower over there. JSW Steel, of course, the reaction came in today, so the final close is down about 1.5% on that stock. UCO Bank, no respite on those NPAs, down about 1% thereabouts. The interesting reaction was continuing on Godrej Consumer, by the way. Godrej Consumer has lost another 4%. Last count, let's just pull up that stock, make that 5%. Put it together with a 7% decline yesterday. This is a massive, massive derating the stock has gone through. Slightly better luck for Marico and for Imami, actually, because the Imami managed to sort of recover quite handsomely from the day's lows. Imami, we should just get Imami on the screen, 3% up, and Marico as well has managed a flat close for what it's worth. Good day for sugar, pretty much all across the board. So if you're looking at Triveni 7%, Balrampur 6%, Sri Renuka, Dhampur, all of those stocks were running. Fertilizers was a good place to be in today. So whether it's RCF, Chambal, Nagarjuna, Madras Fertilizer, you name it, all the fertilizer stocks were up and about, as were tires because of news of that anti-dumping duty being on its way. So MRF, CAT, between 2% and 4%, depending on which stock you are looking at what point in time. Beyond that, I'll just end with some of the other big movers and shakers. Some of the JP Group stocks have lost out quite a bit. JP Associates is entering F&O ban, remember. 9% down on that stock. JP Infra down about 5%. Infibeam is moving out of the ban. That stock was also down about 4-5% today as we speak. And finally, the divestment drive of the government, Hindustan Copper, lots of pressure on that stock. Final take, I think, about 6 to 7% on the lower side. Yeah, make that almost 8% on the lower side on Hind Copper.
Okay, Ajay Srivastav still with us. Ajay, so, you said take a breather. Would that be across the board, or would there still be some stocks where you would want to buy?
To be honest, there are always stocks which you like to accumulate, so you will find some odd things to buy. But when I say take a breather, I think, I think Surabhi mentioned things like Imami. When you see a market where the company gone to a profit of 1 crore, okay, and you still see an uptick in the stock price, you think something is nutty about what the market is all about, which is why you take a breather, you take a calm breath and say, okay, I need to reevaluate my portfolios. Now, what you need to buy? I think what you need to buy are sectors which have got left behind. You have something in the chemical sectors, you have got something else happening in the infrastructure sector. Now the question is, they got left behind for a reason. So that's why I said that you got to be very careful. Are you bottom fishing some of the stocks? That's one. Number two, which are the sectors which will gain from here and onwards, even at the astronomical valuations? And number three is that do you have the capital to stay there long for the cause? I think that's the three aspects to this. Now, you will have lots of smaller companies which have done better or worse, but you have to stay the course for a long while. You have some of the companies which are rehabilitating itself, using like a GMR equivalent, may get re-rated with the airports which are coming up, etc. So that re-rating might happen. They're already in the fray for 2 other airports. So those re-rating might happen. But on the bigger ticket size, I think you are now riding a tiger, because let's say Maruti, for instance, is seen a one-way run. You've seen Eicher, it's a one-way street out there. So yes, you are a little bit safe there in company of lots of institutions, but the breather was that look at what's happening in the month of July, August, because this is a festive season, this dictates a policy, and then you go and jump into the market at this point of time. If you're heavily invested, I think you stay out of it. If you're modestly invested And number three is, you might even find that the bond funds might even give a better return in the next 3 to 6 months if this cut cycle continues, and if the industry doesn't expand, if the IIPs, what it is, numbers are looking like, you will see more and more liquidity overhang in the system, giving sustenance to bond. So it's not a bad deal to be in bond at this point of time. Therefore, you need to prepare yourself on the equity and be patient with it.
Okay, that sounds slightly ominous. Ajay, you're saying maybe bonds are better than equity right now. But I mean, I don't want to be, raising some kind of an alarm bugle here, but are you, hinting at the possibility of a correction? If so, how deep?
Well, we have been booking profits quite a bit in the last 1 week or so, to be honest, Surabhi. A lot of portfolios we book profits in and advise profit booking. And the reason is simple, that if you have to see a run-up from here, you have to see a strong run-up in the fundamentals of the economy at this point of time, where we have a doubt that is what going to have a run-up is going to be of the magnitude that is factored in the prices. It's not cheap pricing anymore. So we are the thought that yes, we are not sold out everything. We're not that we are out of the market completely, but it is time to book profit, take some money to the bond funds and wait a while. Maybe the market might zoom up another 500 points tomorrow. Who knows? This market's mood is absolutely unpredictable at this point of time. But I think you better be safer than sorry at 10,000, 1100 with index running. And that's when I quoted when he said, Imami, that when you see behavior of that kind in the market, you kind of worry that, listen, is this something so rational happening there? You saw, I said Godrej Consumer had a 10-12%, that run-up was huge and it's changing. But some stocks just don't see a correction, and those stocks are not performing at all. And in fact, they're flat quarter-to-quarter earnings. The only sector which made money was sugar, by and large, which you saw the results of DCM Shriram, etc. So commodity stocks are doing well. Maybe they'll do well in the season. So if you really want to invest, maybe better to invest in commodity stock linked to the festival season. Or you go very long term. You pick up a Arvind or a Raymond and sit for 2-3 years and expect a big turnaround to happen in those companies. So this is that peculiar time of the year and the index that you really need to pick up the long-term winners who can give you a healthier return than the bond market.
Okay, always a pleasure listening into your views. Thanks, Ajay, so much for joining in. Let's see what this market throws at us over the coming few days. Thanks very much for joining us today on Policy Day. Quick break right now. On the other side, our coverage is going to continue on what the RBI has done today and what they're hinting at for the future.